Good morning. While most investors were asleep, something very serious happened in the silver market. Prices didn't just move, they were pushed. When COMEX opened, silver was already under pressure, and within minutes it became clear this wasn't a normal sell-off driven by fear or bad news. This was structural. Overnight, the exchange quietly raised margin requirements on silver contracts, and that single decision instantly changed the rules of the game. Traders who were bullish on silver suddenly had hours, not days, to come up with thousands of dollars in extra cash or face forced liquidation. For many, that wasn't possible. Screens lit up red, positions were closed automatically, and silver began to slide. If you're new to this market, it probably looks like silver is failing again. If you've been around long enough, you know this pattern very well. This isn't weakness, it's pressure. What you're watching right now is not just price action, it's a mechanism. Futures markets don't move purely on buying and selling. They move on rules, margins, limits, and liquidity. When an exchange raises margin during volatility, it doesn't hurt everyone equally. It targets the most leveraged participants first, the so-called weak holders. Today, COMEX increased silver margins to $25,000 per contract, forcing traders to either inject more capital immediately or surrender their positions. At the same time, reports suggest position limits may have been reduced, tightening the vice even further. The result is predictable: forced selling, falling prices, and relief for short sellers who are under pressure as silver move higher. In this video, we are going to break down exactly why this happened, who benefits from it, and why moves like this don't change the long-term reality of silver at all, even if they shake confidence in the short term. Overnight, the silver market didn't react to news, earnings, or economic data. It reacted to a rule change. COMEX raised margin requirements on silver futures, meaning traders suddenly needed significantly more cash to hold the same position. Margins jumped to around $25,000 per contract, an increase large enough to instantly pressure leveraged traders. This move came at a sensitive moment, with silver already volatile and liquidity thinner than usual. As Asian markets opened, many traders simply couldn't meet the new requirements in time. When that happens, positions aren't negotiated or debated, they're liquidated automatically. Selling begins not because traders want out, but because the system forces them out. That wave of forced selling is what pushed prices lower. Importantly, this drop didn't reflect a sudden change in physical demand for silver. Mints didn't stop buying. Industrial users didn't cancel orders. What changed was paper positioning. Futures markets are highly sensitive to margin rules, and when those rules tighten, price often falls even if fundamentals remain unchanged. This is the key distinction most retail investors miss when they panic during events like this. Margin hikes never impact all market participants equally. The first to be hit are the weak hands, traders using high leverage with limited cash buffers. These are often short-term speculators chasing momentum, not long-term investors. When margins rise, they must either add capital immediately or exit. Large institutions, banks, and well-capitalized funds don't face the same pressure. They have deeper pockets and, more importantly, advanced notice and risk models prepared for these events. This is why margin hikes often appear to save short sellers. If silver was rising and shorts were under pressure, a forced liquidation of leveraged longs provides instant relief. Selling begets more selling as stop losses trigger and margin calls cascade. Meanwhile, the same institutions that benefited from the sell-off can quietly re-enter positions at lower prices. This isn't conspiracy, it's market structure. Exchanges claim margin hikes are about risk management, and technically they are. But the timing of these moves often determines who survives and who doesn't. Understanding this dynamic is critical, because it explains why price drops during margin hikes don't necessarily signal weakness in the asset itself. One of the most important things to understand right now is the difference between paper silver and physical silver. Futures contracts can be created, liquidated, and closed in seconds. Physical silver cannot. During this sell-off, the futures price dropped sharply, but physical silver prices barely moved in comparison. Premiums at dealers remained elevated, inventory stayed tight, and demand did not suddenly disappear. This tells us something crucial: the volatility is happening in the paper layer, not the real metal. Futures markets are dominated by leverage, algorithms, and short-term positioning. Physical markets are driven by supply constraints, industrial demand, and long-term monetary trends. When forced selling hits futures, it can temporarily distort price, but it doesn't change how much silver exists or how badly industries need it. Historically, these divergences often appear before strong moves higher, once the forced selling exhausts itself. That's why experienced investors watch physical premiums and delivery data instead of panicking over screen prices. When paper breaks down but physical holds firm, it's a warning sign, just not the one most people think. It's easy to assume that sharp drops mean a bull market is over. In reality, the strongest trends often include the most violent corrections. Margin hikes are designed to reduce speculation, not to kill long-term demand. Once weak positions are cleared, volatility usually compresses and the market stabilizes. The irony is that these shakeouts often make the market healthier. Excess leverage is removed. Positions transfer from impatient traders to stronger hands. The trend doesn't die, it resets. From a technical perspective, this kind of move often creates a base rather than a top. From a macro perspective, nothing has changed. Global debt is still rising, currencies are still being debased, and industrial silver demand continues to grow. Short-term price pain doesn't override long-term structural pressure. Investors who confuse margin-driven liquidation with genuine market rejection often exit at the worst possible time. Understanding why volatility happens allows you to separate emotion from structure, and structure is what really drives markets. What happened today wasn't random, and it wasn't a verdict on silver's future. It was a reminder of how powerful market mechanics are, and how dangerous leverage can be when rules change overnight. COMEX didn't sell silver. Investors didn't suddenly stop believing in it. The exchange adjusted margins, and the weakest positions were forced out. That's all. For short-term traders, this kind of environment is brutal. For long-term thinkers, it's revealing. When paper markets whip violently but physical reality stays firm, it exposes where true value actually lives. The key lesson here is simple. Price is not always truth, especially in leveraged markets. Understanding who is forced to act, and why, matters far more than reacting to a red candle. Volatility feels like chaos, but it usually follows a very precise logic. If you can see that logic, you stop panicking and start paying attention.
Hello friend, welcome to my YouTube channel. I hope all if you are doing great and having an amazing day. My name is Noor Baqi and I am really excited to start this new journey with all if you. You know, this channel is not just about videos, it is about story and ideas and inspiration. I created this channel to sharing something positive every signal week. Sometimes we all need little motivation, and sometimes we just need a good story to smile again. Decide exactly what this channel is all about. You find understanding stories, real life experience, and powerful lessons that again change the way you think. I be uploading new videos regularly, so if you don't want to miss any of them, make sure to subscribe to my YouTube channel and press this bell icon so you get notification when you post something new. Your support means everything to me, and to great we can build a community full of fraternity, learning, and good vibes. So sit back, relax, and let us begin this amazing journey together. Thank you so much for watching and welcome once again.